So the big question, of course, is the labor market still too hot? Joining us now, Joe Brusuelas, RSM Chief Economist. And Joe, great to have you on. I'm just curious, how does the market continue to price in 6 cuts after this data this morning?
Well, the market's going to pull back. It's a little bit over its skis. The bond market's overbought right now. So rates, the long end's going to go up. Look, when you take a look at this morning's data, you mentioned resilient. I like that word, right? Because my theme for last year was resilience, not recession. Okay, so what are we seeing here? A labor market that's broadly cooling. The acyclical sectors, what you want to see, meds and eds, healthcare, education, social assistance. We see hiring there as the market pivots and the economy pivots to a little bit of a slower pace of growth in the first half of this year. I liked what I saw. You know, you mentioned the wage growth, right? So let's say that's your metric, 5.4% on a nominal basis. Once you back out inflation, let's say 3%, what's that tell you? You get 2.4% increase in real wages. That's what's going to continue to propel this economy, even as some areas continue to have some problems. Obviously, manufacturing hasn't quite gotten out of it, although we know because we can see all those factories that are being built. That's going to be a second half story. And of course, the problem's in real estate right now. Right? But nevertheless, the consumer is hanging in there in a very solid fashion, and hiring is just going to continue to do better. Tomorrow, I expect 135. Now, it's below the consensus of 170, but that has to do with the difficult seasonal adjustments around retail, warehousing, and transportation. Normally, you know, say 10 or 20 years ago, you would have seen a big jump in December on those. Not so much this year.
So, Joe, how do you think the Fed is potentially, not so much that they're examining this number, but if they look ahead to tomorrow, if we do see 135 like you're expecting, even if we do see 170, which seems to be consensus right now on the street, is that still a bit too hot given the fact that that last leg, the last mile here in this fight against inflation could prove to be much stickier, much trickier than maybe we had initially anticipated?
So if you're a central banker, you're looking at, well, if they get, say, anywhere between 135 and 170, you're going to end up with 2.7 million jobs created last year. Big smile on the Fed's face. Second, they do think that disinflation is moving through the economy at a slow pace. That will create the condition for a decline in the federal funds policy rate, simply because at 5.5 on the upper boundary, it's too restrictive for an economy that's likely to move back towards a 2% trend growth rate this year.
So where do we look in the data for clarity, at least from the market's perspective? Because I'm seeing a lot of unchanged action and maybe a bit of confusion about what to do off of this data.
Well, so if you're a forward-looking investor, right? What you're looking at probably is more the inflation aggregates and some of the metrics that you can pull out of that rather than backward-looking hiring data. So if you're a forward-looking investor and you're trying to estimate where policy is going to go, you're going to be looking at housing, where the inflation rate's moving there. And then, you know, really you want to see services inflation begin to abate. That's not exactly where the Fed wants it to be, which is why in that minutes yesterday, they said rates are going to remain restrictive for some time, even as they're creating the conditions to reduce rates later this year. And by the way, ladies, if you're an investor, I want to pull one big thing out of that report, that Fed minutes report. They're creating the conditions whereby they're going to end quantitative tightening, likely later this year or early next year. That was really overlooked yesterday afternoon. I was on the airplane coming in and I read through the minutes and I thought, okay, this is it. Boy, and it doesn't matter what asset class you're in.
Did the market miss that?
They missed the market, completely missed that, you know, because if QT is going to end, that's going to result in an improvement in liquidity conditions, and that helps everybody across all asset classes. That's, if you're going to be bullish, that's what you want to hang your hat on right now.
So then is the market maybe not too optimistic just in terms of the outcome that we could see given policy moves from the Fed? Yes, maybe they're too optimistic in pricing in 6 rate cuts for this year, but given the fact that we could see an end here to quantitative easing, maybe there is a reason to be this optimistic at this point.
So traditionally, when the Fed reaches its peak in its rate cycle, you see an increase in the equity valuations of 20 to 30%. We're already there. I think that the market got this portion of it right now, the 6 rate cuts. No, I mean, I think maybe 4 rate cuts this year. That would make sense to me, just given, because rates are just too restrictive for where the economy is and where it's likely to go. But 6 rate cuts, a little bit too giddy for me.
When do you think we'll see the first?
June.
And last time we had you on, you said this is what soft landing looks
That's
like.
right.
Is that still your base case?
Yes, that's our base case forecast for the year. And look, I think the major takeaway when we get through tomorrow morning at 8:30, the pandemic era in terms of the labor market's now behind us. We're now at the new normal. That's something to celebrate. And then that's also going to be the main lift for all of the investors out there, all the economists, all the strategists, which is how are we going to define this new post-pandemic era economy that we're now living in? What's going to be the driver, and then where are the risks? Obviously, we can turn on the news this morning, look at what's going on in the Eastern Mediterranean and figure out where the risks are, right? But those growth drivers, well, that's still, up for discussion. I think it's a very resilient consumer household bolstered by rising real incomes. That's, to me, is going to be the story here this year.
All right, Joe Brusuelas, always great to get your insight. Thanks so much for having on set here with us this morning. Always great to talk to you.